Good morning, everyone. We are Group N from tutorial T05, and today we'll be presenting our project titled Solar Tech Components, Financial and Ethical Analysis. My name is Chai Kaiter, and joining me is my teammate Ko Jiajie. Our goal today is to show how Solar Tech integrates financial decision making with ethical and ESG principles to achieve sustainable competitiveness. Over the next 15 minutes, we'll walk you through our analysis, beginning from SolarTech's background and strategic goals to its financial viability, ethical challenge, and recommendation for future success.
Okay, so here's an overview of what we'll cover in today's presentation. First, we'll look at SolarTech's company background and its strategic goals. Next, we'll identify key ESG challenges and assess the company's financial performance through a break-even and CVP analysis. We will then present a 3-year cash budget summary, followed by an ethical interpretation of the results. Finally, we'll show how ethics and finance are connected to SolarTech strategy and competitiveness before wrapping up with our key recommendations and conclusion.
Who is SolarTech? SolarTech Components is a Malaysian solar component manufacturer based in Penang. The company has around 250 employees and generates approximately RM 25 million in annual revenue. It specializes in producing photovoltaic components mainly for export markets, contributing to the global shift toward renewable energy. However, despite being in the green energy sector, Solartech faces ESG-related challenges, including reliance on non-renewable grid electricity and limited workspace diversity. These issues have impacted its reputation and raised questions about whether the company truly operates sustainably.
Okay, so next slide, the business growth overview and the strategic goals. So SolarTech began as a small local producer and rapidly expanded through international exports. While its revenue increased, so did its operational and ethical challenges. The company entered an expansion phase, but this growth came with higher energy use and lower diversity, attracting stakeholder criticism. In response, the 2025 recovery plan was introduced to strengthen ESG performance while maintaining profitability. So the company's strategic goals are to first integrate ESG principles into all financial and operational decisions. Second is to enhance competitiveness through sustainable innovation. And third is to maintain profitability while ensuring long-term ethical responsibility. And these are the goals that form the backbone of SolarTech's transition toward a more responsible business model.
SolarTech's ESG challenges and responses. SolarTech's ESG journey has been both challenging and transformative. Among its main challenges are heavy dependence on grid-based electricity, low diversity in technical and leadership roles, and minimal ESG disclosure to stakeholders. In response, Solartech has taken several steps. It invests in solar power system to reduce carbon emission and operational costs. It launches a diversity and inclusion program to promote gender and ethnic balance. And it committed to formal ESG reporting starting from 2025. These initiatives reflect a strong ethical direction. Even though they increase short-term costs, they strengthen SolarTech's social license to operate.
Okay, next, let's examine how those ESG investment impact SolarTech's financial position. Before implementing ESG initiatives, fixed costs were about 7 million with a break-even point of 1.4 million units sold. After the ESG investment, fixed costs rose to 9 million, pushing the break-even point up to 1.8 million units. This means the company now has to sell 400,000 more units to start making profit. While this may seem like a setback, this investment positions SolarTech for long-term savings and a stronger brand reputation. So even though the margin of safety did narrow in the short term, the strategic benefits outweigh the temporary financial pressure.
CVP analysis strategic options. We then evaluated two possible strategies for improving profitability after ESG adoption. Option A, price adjustment. Solartech could increase its selling price by 40 cents per unit, bringing it up to 15 and 40 cents. This would increase profit to about RM 1.8 million, but there's a risk that customer may react negatively to higher price. Option B, volume growth. Alternatively, the company could focus on increasing sales by 12%, reaching 2.24 million units. This yields a higher profit of 2.2 million, but it requires expanded and marketing and production capacity. In conclusion, option A offers a safer short-term recovery, but option B delivers high returns and align better with SolarTech's long-term growth goal, provided the company can handle the operational demands.
Okay, so for slide 8 profit comparison, here's a visual summary of those results. So the chart compares profit before ESG under option A and under option B. Before ESG, Solartech earned roughly 3 million in profit. Option A drops profit to 1.8 million, and option B recovers it to 2.2 million. This comparison highlights that even with increased ESG costs, Solartech can still regain profitability through well-planned strategies.
Okay, now let's look at SolarTech's projected cash budget. In 2025, the company expect a cash deficit of around RM 300,000, mainly due to large upfront ESG investments. By 2026, operations stabilize and SolarTech achieves a small surplus of 50,000. As cost savings began to appear, finally in 2027, the company projects a healthy cash surplus of RM 600,000, thanks to improved operational efficiency and lower energy costs. This three-year progression demonstrates responsible planning. SolarTech is willing to absorb short-term loss for long-term financial and ethical sustainability.
Okay, for slide 10, cash budget highlights. This bar chart visually represents the same trend. As you can see, SolarTech's cash flow moves from a deficit in 2025 to being more stable in 2026 and into a strong positive territory by 2027. The upward trajectory shows that ESG investments are not just ethical choices, they are financially strategic, producing measurable recovery and profitability over time.
If we analyze this ethically, we can view SolarTech's journey as a reflection of long-term integrity. In 2025, the cash deficit symbolizes ethical investment, choosing sustainability over instant profit. In 2026, the recovery shows resilience and accountability, balancing financial results with ethical responsibility. By 2027, the surplus confirmed that doing business ethically does pay off. SolarTech proves that profitability and sustainability are not conflicting goals. They reinforce each other when managed strategically. This is the essence of ethical finance, creating value that benefits both the company and society.
SolarTech's case reveals that integrating ESG with finance is not optional, it's essential for today's market. Ethical finance means taking responsibility for environmental and social impacts, not just financial returns. By embedding ESG's principles into its budgeting and cost structure, Solartech strengthens brands' loyalty, attracts investors, and gains access to green financing opportunities. This approach reflects integrity-driven leadership, the kind that builds long-term competitiveness and not short-term wins.
Linking ethics to strategy means turning moral principles into measurable business advantages. For SolarTech, Ethics enhance reputation, stakeholder trust, and customer loyalty, all of which drive market competitiveness. Buyers, governments, and investors increasingly prefer sustainable suppliers, so ethical performance become a strategic advantage. By aligning ethics with strategy, solar tax ensure that financial growth is sustainable, resilient, and future-oriented.
So, for the governance and stakeholder trust, good governance is the foundation of ethical success. Solartech must strengthen transparency through annual ESG disclosures, the continuous stakeholder dialogue, and a formal ESG committee. Such governance builds accountability, ensuring that Solartech's ethical values aren't just statements but embedded practices. This approach attracts investors and reassures customers that SolarTech is a trusted, responsible partner in the renewable energy industry.
Recommendations. Based on our analysis, we recommend three key actions. Adopt the volume growth strategy. It offers stronger long-term profit potential while maintaining market competitiveness. Utilize green financing. Secure funding from sustainable finance institution to manage cash flow during ESG transitions. Strengthen ethical governance. Publish ESG reports annually and tie executive incentive to sustainability outcomes. Together, these recommendations create a balance between financial performance and ethical responsibility.
Okay, so in conclusion, our analysis shows that SolarTech remains both financially viable and ethically strong. Even though ESG initiatives increase short-term costs, they build a foundation for future profitability, transparency, and reputation growth. The company's journey demonstrates that ethical decisions are also financially strategic when implemented effectively. So SolarTech isn't just producing renewable components, it's becoming a renewable company in spirit and practice.
We would like to acknowledge the use of AI tools such as ChatGPT to support report editing and formatting. All analysis and final interpretations, however, will reviewed and finalized by our group to ensure accuracy and originality. Thank you very much for your attention. We hope this presentation has provided a clear picture of how SolarTech integrates ethical decision making into financial performance.
Thank
Thank
you,
you.
thank you, thank you.